Thank you so much. Yeah, my name is Katie Martin. I'm the markets editor at the Financial Times in London, and this is my first trip out of London for an embarrassingly long time. It's really nice to be here. We're going to be covering in this session capital markets in the wake of the pandemic and the current geopolitical crisis, which could mean anything. We've got an hour to get through a huge amount of information here, but just to set the scene a little, it's obviously been quite the ride in capital markets over the past couple of years. Everybody's had to completely reshape how they work, whether that's issuers, investors, or all the banks and intermediaries in between. We've had to run markets and newspapers, for that matter, from living rooms, which we never thought was possible, but turns out that it is. So now we're in the process of picking up the good practices that we picked up during that process and running with them and chucking out the stuff that we didn't like. And at the same time, there's a huge amount of urgency to deal with really powerful macroeconomic and social forces, placing new demands on industry leaders like the people on the stage with me here today and on everyone else in this room. And it really feels like the rules around everything from geopolitics to sustainability are changing really fast. As one investor put it to me recently, it feels like the investment landscape divides into the time before COVID and Russia and the time after. It's a completely different game for fund managers now. So we're going to talk over the next hour about how the industry is responding. As I say, I've got an excellent range of market participants here, and it's great that each of them comes from a slightly different perspective and part of the industry, so we should get a really rounded view. I'm reliably informed that any of them could easily talk for an hour on their own, so wish me luck in keeping them in order. They are Christoph Boschan, who is the CEO at the Vienna Stock Exchange, Bertrand de Mazières, who's the Director General for Finance at the European Investment Bank, Martin Moloney, Secretary General at IOSCO, Henrik Raber, who excitingly is joining us through the power of the internet. He's the Global Head of Credit Markets at Standard Chartered, Angelika Sommer-Hemetsberger, who's an Executive Director at OeKB, and last but not least, Stoter, who is the Global Head of AXA IM Core. So you in the audience, in real life and online, will have the opportunity to ask questions towards the end, but for now, it's my turn. So I'm going to start off just by asking each of them to briefly introduce themselves and tell us what's the really biggest change you've experienced over the past couple of years. Christoph, I'll start with you.
Yeah, very warm welcome from my side as well, and being among the few locals.
Yeah.
I really mean it. I hope you all received a very warm welcome here in the city, and I hope you all managed to reserve at least a little time for some kind of cultural program. Vienna is not necessarily the financial center of the world, but it is for sure definitely one of the most impressive cultural centers of the old continent. Yeah, Vienna Stock Exchange, which consists of two exchanges actually, the Vienna Stock Exchange as well as the Prague Stock Exchange. We fulfill the incumbent role of a national exchange on both ends, and yeah, beyond that also play a significant infrastructural role as we support plenty of other markets in the CE region. And yeah, that's basically it.
And the biggest challenge you've had to face over the past couple of years?
The biggest challenge, yeah, that was obviously operational issues in the course of the pandemic, the transition into the home office, which was actually not that challenging because the exchange business as such is digitalized, has been digitalized for over 20 years now, but there are plenty of IT security issues that coming along with that, and that was quite challenging to cope with that one.
Yeah, definitely. Bertrand?
Yeah. So I'm a bit impressed to speak now because one of my shareholders just spoke, the Bundesminister for Österreich, and what he said is, I think, quite telling. He spoke mostly about climate, and I think that one of the lessons learned of the past 3 years of crisis is that we should not forget climate, whatever happens. And actually, we may be now extremely impressed by what's happening not too far away to the east, but there is an interesting conjunction of facts, which is that when the war in Ukraine started, in the same week, we had the sixth interim report of the expert group of the United Nations on climate that warned us that actually the window for addressing climate in ways that we escape the worst possible scenario, this window is closing very soon. So it's certainly one of the lessons I will return for the past few years. Let's not forget about climate, and climate remains one of the main themes of EIB. Having said that, we learned also other things. First of all, the pandemic was a bit of a real life experience in using digitalization, even without having been prepared for that. So innovation and digitalization certainly remains extremely important. We need to embrace innovation, and even to embrace innovation, obviously with proper risk analysis, but taking risk. And to give you an example, EIB decided to invest into this famous German firm. I will not make any publicity, that started to work on the messenger RNA technology and actually developed the famous Pfizer vaccine, and we're quite proud to have identified this institution, this corporate, way before the pandemic, as actually someone it was important to invest into. So look at innovation. We have also to look more and more at the social imbalances that the situation is creating, and we are working with the Commission and Development to develop a just transition program, a just transition initiative, to ensure that our finance also go to those who are most in need, given the fact that some regions, some even social classes are not as well equipped to meet the challenge of climate change than others.
Yeah.
And I'll stop there, but there are a lot of, and also speed, and speed maybe for some of us, Europe and the EIB are not the epitome of speed, but I would dispute that. And I think we learn to be extremely quick in our decisions. And just to give you an example, within 1 month only, we unblocked almost 700 million euros to Ukraine in February, March. So we're learning to be also quite effective in speed.
You have to be nimble, exactly. Thank you for that. Martin.
Your question is a great question, because it made me think, what were the sort of moments over the last couple of years that actually I changed my mind about something, or moved to a different perspective, or moved to an entirely new set of tasks. And there are actually 3, I think. I remember at the time that COVID came along, doing the first webinar I did at the time, I was slightly exasperated at the time. I remember saying as part of the webinar, look, we can't keep doing 1 in 100-year events once every 10 years. And that sense that we were layering sort of crisis on crisis, and that as a system we weren't able to cope with it, was a concern at the time. And very much driven by the fact that I had spent a lot of time after the great financial crisis working with IOSCO and the Financial Stability Board and others on a quite complex set of reactions to that particular set of events, which was really difficult to do and isn't even finished as we sit here today. So then you start thinking, can we layer another crisis on top of that with a whole new set of lessons? And then after that, the impact of the Ukraine invasion happens on the financial markets. And okay, we've got another one. Then it does change your thinking a bit about resilience, and about how the industry should plan around resilience, and how you should think about scenario analysis and stress testing and so on. And that's quite, I suspect, that's quite a fundamentally different way of thinking about crisis management and about building resistance within the financial sector than we would have had 5 years ago, where we would have thought of it quite simply as, well, let's figure out what's the most likely terrible thing to happen, and then let's build resistance against that. I think we're now in a space where it becomes increasingly clear that's not the way to think about things. Yeah. You have to think about your organizations as having nodes of vulnerability, and trying to plan for things that you don't know what they're going to be. Yeah. And trying to, in some proportionate way, to allocate budget to dealing with those in ways which is not just undisciplined, but at the same time is proportionate to the risks you face. So there's something quite fundamental in the way I think boards, companies, and the whole sector is beginning to shift in the way it thinks about resilience. That would be my first one. My second one relates, and I'll be quicker on this, relates to ESG and the move into that area. Not surprising in everyone's thinking, but for me, the moment of transition, which was quite recent, was when it became evident to me that there is a path forward where we can succeed in building a structure to allow this sector in the future, not today, but in the future, to have the information available, to build the kind of analysis, to try to do its job with a totally different set of mandates from investors than the traditional mandate, which is just to maximize return, long, medium, or short term with high, low, or medium risk profile. We have a different set of mandates in the marketplace now, and I think we can think about the path forward, and there is a good path there. The third one relates to crypto, and I would have been one of the skeptics in relation to crypto for many years. At the time of the ICO craze some years ago, I was on the board of IOSCO and was one of the first people to push for coordination among regulators to try to fight what seemed like the mother and father of all scams, really, and hype, and which was just a terrible situation where people were simply losing lots and lots of money in investing in things which had patently no substance or prospect of any future. And that's how most of them turned out. But crypto has changed, and I think the changes that have happened since then have made many of us reflect that our reaction, our approach to crypto needs to change as well.
It's interesting. We can get into some of the details of that during the course of the discussion. Angelika, I'll come to you very shortly, but I just want to bring in Henrik, who's far away in Singapore, I believe. Henrik, how's life changed for you? What's the biggest challenge you've had to face?
Thank you. And I'm delighted to be speaking to everyone from Singapore this evening and during today. For us, I think it's been touched upon already, has been the pace of change. We started with the financial crisis, and now we're quickly moving through many crises. But if you look at the other side of that coin, I think the real positive is how the markets have been incredibly resilient through the many different crises that we'll have, and I think we'll continue to have as we look forward in the coming years. In particular, I think the market infrastructure has been incredible, and the innovation for us to handle, for example, credit risk and move that capital around globally from local markets to global markets has really continued the economies and continued to see supply chains operate reasonably well, despite some very big challenges for us. So I'm really impressed by the resilience that the market has offered and the time and effort and the infrastructure that's been put in place the last 10 to 15 years. I would also, in the credit world in particular, highlight how we've seen some of the credit markets change, and I'm sure we'll touch upon it during this session, is also the rise of private capital, which has proven to be incredibly nimble in filling into places when the public markets have been closed. So the pace of change, and I think that's going to continue to be something that we operate with. And as an industry, we've done an excellent job adapting to that and innovating and delivering capital quickly as required by our clients, our customers, and obviously the broader economies. Thank you.
Yeah, it's a good point. And, you know, not only was everyone stuck at home in the worst bit of the lockdowns, but there was just a huge amount of capital markets work to be done. And it is impressive that that went more or less without a hitch. Angelika.
Well, I want to kind of touch upon a few points that have been mentioned already. I think the first one was that with the beginning of the COVID crisis, when we kind of moved to the home office, the whole operation of the bank to the home office, that it worked so well was not a surprise because we had worked on that before, so we were very well prepared. But I think the thing is that it really worked well, and as you said, there was a lot of tasks to be done. There was a lot of activity on the capital market. There was also a lot of activity necessary for us, also acting as Austria's export credit agency, to support the Austrian economy at that time. And a whole part of our bank was really, really busy, kind of preparing all the guarantees, all the support measures that we did on behalf of the Republic of Austria. So it was a very busy time, and at the same time, we together with Christoph, the Austrian capital market infrastructure worked really well. So it was kind of everything went well. Another topic that really is in the focus right now is sustainability, which has also started before that. So that's one of the points that OeKB is really proud of. And yeah, the actual situation with Ukraine, the conflict is also something that is really keeping us busy.
Yeah.
So those are definitely some aspects that have kept us on our toes in the last few years. But in every crisis there is a chance. And I think it's very good that some of the things that we learned during the COVID crisis are going to stay with us. There is, it was like an accelerator of digitalization. It was more digital opportunities also for our customers. So I think we will keep that on. And I think, so as I said, every crisis fortunately has a little bit of a good thing coming with it.
Yeah. Thank you, Angelika. And Hans, from the buy side, it got pretty hairy there for a while, right, in 2020. How did you keep a hold of your sanity? What's the biggest thing that you've learned here?
Yeah, I think the biggest change, I think, for everybody going into COVID was, okay, is this going to work, right? We're all going to be home, and is this actually going to hold? And I think it really changed in a positive way, our appreciation for our operational technology teams, because it actually worked. And if this crisis would have happened 10 years earlier, I really would be worried about what would have happened, because I don't think we would have been ready. So in that way, it was a good operational test. All our BCP plans that look always boring, all of a sudden seem important and worked. So I think that was really good. It did give us additional challenges, though. I mean, how do you, we figured out how to work from home and get the operations done, but how do you onboard new team members? How do you train young people that best learn next to a senior? How do you get the creative juices going in a brainstorm meeting with 10 people on a Zoom? Right? So that took time. And now that we are back to normal, between quotation marks, hybrid mode, I think we're still learning, because we, of course, know how to run a business with 100% of the people there. We know how to run a meeting when everybody is on Zoom. But how do we do it when 50% is in the room and the other 50% at home? That has its unique challenges. So in that way, it was a good learning experience with some pluses and minuses. The resilience of the markets, I think, was a very important component. And while I think as a sector, we were a bit worried about the regulatory pendulum swinging too far to the tight side after 2008. It was too loose before, now maybe it's too tight. I would say this, but I think too tight regulation is better than too loose, which the last couple of years have proven. So in that way, I think the appreciation for that part of our sector to keep us all stable and safe, I think has helped a lot. And we still, as a sector, I think did very well. Good profitability, growth, and so on during the phase. So regardless of the regulatory tightness.
Yeah. So the unsung heroes of the past 2 years are the IT guys and the regulators. You heard it here first. Hans, I'd like to stick with you if I could, because capital markets are sort of meaningless unless they do what end investors actually need. And the market environment that we're seeing at the moment is, again, extremely challenging. We've got inflation in Europe. Who knew that could actually happen? Asset prices have had a very rough time recently. Do you feel like we're on the cusp of a bigger correction? What's your assessment of market conditions at the moment?
Yeah, of course, we already had quite a big correction to begin with, right? So it seems long ago, but on January 1, I think in general, we were all quite bullish, quite optimistic. We were coming out of the pandemic, things were looking better. We were looking for a growth boom with all that savings that every household had that it couldn't spend during COVID, all available to go and spend. And on top of that, we got massive fiscal and monetary stimulus still ongoing. So the growth boom is there. Seems that the world has completely changed. Ukraine, zero COVID in China, with on the one hand very negative implications for energy and food prices, of course. On the other side, very negative implications for supply chain, with the result of quite reduced growth expectations, significantly reduced, and booming inflation. Now, one thing about inflation is when you said inflation in Europe, who would have thought? When there was no inflation in Europe, everybody thought it can never go up. Now, when we have inflation, everybody thinks it will never go down. I'm a bit more mean reverting in that opinion. So I think that oil prices might stay high, food prices might stay high, but that means next year they have zero inflationary contribution.
Yeah.
So I think we will go back to a more normal pattern. But in the meantime, central banks, of course, are in a difficult balancing act where choking off growth to fight inflation is a challenge, right? And so for that, the central bankers, I think we should. They're trying to solve a puzzle that they haven't been confronted with for many years. The implications for markets have been quite significant. I mean, equity markets, obviously, interest rates going up. I mean, I'm in the financial industry now for more than 30 years. This is the first time in 30 years that we probably see a structural increase in interest rates. Yeah. So most of us in this room, I'm quite old, so I can say most of us, have not experienced a significant rise in interest rates through markets over a 5 or 10 year period of time. Right? So that will change the way people look at markets, and has significant implications for the asset allocation choices that people make. The good thing is that for fund managers like us, Tina, there is no alternative but equities. Those days are over, so that's good news. Our clients are still quite risk averse, although I do see the beginning of especially short duration credit strategies. There's appetite coming back. Equity still very difficult with our clients, with day-to-day volatility staying so high, 1% up, 1.5% down the next day, and then up again the day after. That does not instill any confidence with our client base. So therefore, yeah, we do see good demand for fixed income strategies picked up with yields now much more attractive. People do not want to miss the entry point, so they're averaging in.
Yeah.
But on the equity side, it's still a challenge.
Yeah, it's really rough. I mean, Henrik, what's your view here? Because we do find ourselves in the odd situation where high yield actually means high yield again. There has been a big correction already this year. What does this mean for borrowers, and particularly in emerging markets?
Predominantly from Africa through to Asia, the inflation and the change into the cycle is very material. If you look at the performance year to date, most emerging market, investment grade emerging market funds are down between 14 to 18%. And in fact, the investment grade space globally has underperformed what has been classified as high yield, with leverage loans in the US being an outperformer, partly due to being LIBOR based, but also during the higher coupons they have. I think one of the largest worries that we have is inequality and how that's going to accelerate. Many of the emerging margin companies are obviously going to be infected by this, but also on the sovereign side, many of the countries in our markets are importers. Of course, there'll be exporters who are going to benefit, but there's also a price point on oil, for example, where even the exporters, because they import refined products, are really going to struggle. We have seen this in a major correction in some of the sovereign debts. And as you look at more extreme examples, we've seen the challenges, for example, that Sri Lanka is currently facing. And if you look away from the financial markets and start looking at food prices, this could potentially lead to further instability. So I think from the inflation point and the shock that we've had in Q1, our major concern in EM space currently is around how this inequality is going to potentially really accelerate. And we do have in emerging markets many countries with quite significant debt burdens already, which at some point, even before the war, were a challenge for them and had just come out of quite a challenging COVID period. We also need to remember in our emerging market space, many countries had quite a difficult COVID period. Across our footprint, only about 16% are actually vaccinated, and we're all aware that the zero COVID policy in China continues. So we see quite asymmetric risk appearing from this, and inequality being one of our largest concerns, and how some of the governments are going to be able to manage through this period. As we go into the IMF meetings in October, I think we're also going to start to hear more about debt transparency, the DSSI, and potentially the private sector being asked to step in even further than it has done around some of the sovereign borrowing levels.
Yeah,
Thank you.
This could be a golden age for sovereign debt restructuring lawyers, is the worrying thing that could happen. So we've all spoken already about the remarkable resilience of the system when everything shut down. I mean, Christoph, from your point of view, was that more by luck or by judgment? You know, how on earth did we manage to get through this unscathed?
Yeah, simply because the underlying technique is a very reliable one. I mean, one should not forget that the exchanges have quite a long history of providing stable systems to the market. The exchanges have been fully operational throughout the whole of the financial crisis, as they have been throughout the whole of the COVID crisis. The challenges more lie in the OTC space, I must say. Right. And you all know that the regulators tried to tackle that with, particularly taking the regulatory frame set of the exchanges and transition that into the OTC space. So whenever it comes to question how to inform the investors before the trade and after the trade, accompanied by a settlement security, clearing guarantees, that has then all been introduced in the aftermath of the financial crisis and really fostered the OTC space as well. And may that also contributed to the stability of the systems now in the recent COVID crisis.
But do you think it means that we need additional investment in the technology to make sure that we retain that resilience now?
Concerning the technology, no, definitely no, because there's absolutely no need for that. Systems prove to be more than reliable. Yeah. We have seen 100% availability within our infrastructure in 2021. And no, definitely no need for further regulation there.
Not more regulation, but more spending. You know, it's obviously an important part of ensuring resilience.
Look, that is a constant obligation of every diligent management, wherever you conduct it, if it is the OTC space or the regulated world. I think one should take that more serious, particularly in the new blockchain world and blockchain sphere and NFT world and what else there is flying around in this highly suspicious instruments.
And one of the things that obviously changed dramatically was the issuance process over the course of lockdowns, and also the use of new technology there. I mean, Bertrand, can you talk a bit about what new technology you've been using on the issuance side, and particularly with relation to issuance on the blockchain?
Yeah, okay. Indeed, it was, first of all, I'd like to dispel the notion it was issuance using the DLT technology for the registration and the settlement of a bond, but it was not the issuance of a crypto bond. Having said that, in fact, so first of all, we're quite happy with the experience. It was not I would say, a huge piece of our funding program. It was only a 100 million bond, so with 2 years maturity, but nevertheless, we were quite pleased with the experience. I have to say that it required a lot of preparatory work with a lot of partners, including partners in the official sector, in particular one central bank, Banque de France in that case. And I think that in itself, it's quite, it's also a telling feature what's been at work in the past few years, which is, according to me, an increased level of cooperation spirit among market participants. And I must say that we're speaking of a resilience of the financial sectors. First of all, it's true, it's been extremely resilient. Let's not be complacent, but we don't have time to be complacent because there are other challenges. But probably also the regulators, we should recognize the role of regulators of international organizations like ICMA and IOSCO in this result. But coming back to blockchain, why did we look at that? And again, what was a bit novel in this bond is that it was the first let's say, pluri-dealer-led syndication using the LT technology with more than one investor buying into, and also afterwards a real secondary market. Why did we do that? Basically, we think that one of the services we can give to the community, the financial community, and it's a service we can offer actually because we're solid financially speaking. It's a bit of an indirect fruit of our AAA rating, is to innovate and contribute to the formation of market conventions that serve the global interest in markets with new products. This is what we did with green bonds. What we did also with the new risk-free rates, floating rate notes, and that's the reason why we looked at DLT-based issuance. Also, in all three cases, because we thought that these new developments were either a need for the new risk-free rates or a chance of a structural change of the markets. And we don't actually, we have the luxury of not worrying about when this structural change will become mature. In the case of green bonds, for 5 years, it was a confidential market, but it was okay. And I don't plan that DLT-based issuance will be majority in the next couple of years, not at all. Right. But we thought we could do that. It's a lot of work. In the end, it was a very interesting, I think, learning experience for all the actors involved. I think we made clear for ourselves and for the rest of markets what could be the benefit of blockchain, benefit in terms of speed, quicker transaction, quicker time to settle, a benefit in terms possibly of costs, although I don't want to sound mean, but as an issuer, I'm always interested in less costly issuance. And the third thing, and for me, it's structurally probably the most interesting, is a contribution to market transparency. And market transparency, I would say in negative or police way, it will help certainly to implement all the anti-money laundering regulation, but also market transparency positively. And for example, again, I come back to the importance of climate action, but DLT-based managed loans will activate, will facilitate, will digitalize actually the impact reporting, the reporting on the allocation of the proceeds and the reporting on the impact of the proceed allocation on climate. So for all these reasons, we thought that it was good to try this and quite happy with that.
Yeah, and what was the final outcome of the whole exercise? Was it better, faster, more cost efficient?
Yeah, well, indeed. But with a lot of work. and now we're working on 4 other projects at the moment. I'll see which one will materialize this year, probably not all the 4. There are still things to work upon. One angle which is interesting is also to address the legitimate concerns that people may have about the energy cost itself. Yeah. Of the DLT technology, yeah. So we're also looking at that.
Yeah, it's a good point. I mean, Angelika, can you imagine yourself making more use of this sort of technology anytime soon?
Sure. Well, concerning blockchain, we have we first started not experiment, but to kind of play around with it in the 2017 and 2018. In 2018, we actually used a blockchain-based application in context with the auction of the Austrian government bonds, which we do at OeKB. And we used it as a kind of notary service for the notarization of the authenticity of the kind of auction results. So it was not to put the results on a blockchain, but to put the hash on the blockchain so that the document could be identified as the original. So that was the first thing. And we actually, one other project that our OeKB CSD is involved in is a kind of, it's a development project together with the Austrian National Bank, the Austrian Treasury, RBI, Erste, and CSD is involved. It's called Project Delphi, where we are trying to, where the aim is to find out whether it makes sense from a legal point, from a technical point, and from a business point to use the blockchain technology for issuing an, let's say, Austrian government bond settlement versus wholesale CBDC. And actually the simulation of that was finished. The project is in the first phase of the project is about to be finalized, and decisions will be taken on during the summer whether we will kind of go on with that project or not. So that's some of the points.
Interesting. Hans.
Yeah, I want to just use a second to compliment the EIB for their leadership in bringing something like this, because I think it's super helpful for the whole market to bring this forward. It is a big exercise that's in the context of indeed the proceeds and the monetary benefits are very limited, but I think it will seriously help the industry to proceed. We bought a couple of million also for the same purpose, testing, right? How do you trade? How do you settle? How does it go into our portfolios? How do you value it? And so on. And I think the blockchain technology in general will have quite significant implications for the fund industry in general, whether it is subscriptions and redemptions, custody, and so on. It will disintermediate to some extent. It will not eliminate the need for regulation.
Martin, what's your take on this greater use of this technology? You say we need to have a fresh look at crypto.
Yes, I think from where I sit, things have changed quite significantly in the last couple of years for a number of reasons. The first one, I would say, has been the development of decentralized finance. And what's impressive or interesting about decentralized finance as an area is, firstly, it's replicating in many ways on a somewhat smaller scale, granted, many of the structures and activities that you see in more conventional finance. And that capacity, it's almost like a proof of concept, if you like. That capacity, for example, to organize short-term collateralized lending, let's say, in a DeFi space is interesting because it seems to show that it works. It has certain additional investor protection issues like automatic cutoffs that you need to be aware of those, and you need to think around what the regulatory framework should be for that. On the other hand, we see not only the EIB, but others actually experimenting from, if you like, from the more conventional finance angle, and some of those experiments are successful and some of them are not so successful. Some of them prove to be too expensive or whatever, and people drop the proposal. But it's interesting to see from both angles, you're seeing changes, and you're also seeing things such as the development of custody solutions. You mentioned funds, custody solutions that are, I think, beginning to reach the point where regulators would see them as credible.
Right.
And if regulators start seeing the custody solutions as credible, then you start to move into a space where you start to have a conversation about the disintermediation and the potential cost savings in relation to back office, as long as the levels of protection for the customer's assets are not being diluted in the process. We have done a significant amount of work with the CPMI around stablecoins, and that's been something of a proof of concept for us as well, because what we are getting to is a point where we're going to articulate in public a position where we will say, look, this is how we think the principles for financial market infrastructure should apply if a stable coin became a financial market infrastructure. And here's the points at which we think it's critical to be able to hold a human being accountable. And here's the points in which it may be critical to kick the tires on claims around decentralization and nobody being in charge and that kind of thing. So we need to beginning to test some of those ideas. But I think the crucial thing here is the sector itself. I don't think the regulators should be coming up with the compliance solutions. What is striking to me about RegTech is that it hasn't been driven by the crypto enthusiasts. And it's the crypto enthusiasts who need to drive RegTech solutions. So I hear that there are lots of very serious problems around AML, for example, in the crypto space. I don't accept for a second that there's any technological obstacle to devising good compliance solutions in the crypto space. There is the absence, or there has been in the past, the absence of a will to do it, the will to design those solutions. And I think the sector itself is coming to realize that it's not going to become prosperous, it's not going to survive unless it accepts the challenge of compliance and meeting the principle of same risk, same regulation. Doesn't have to be done the same way, but it has to create the same level of protection for investors and the same integrity for markets and the same protections in relation to financial stability. And that's something which it's still the case that I think the crypto sector in particular is only beginning to come to grips with that as a challenge for itself, not for us. You still see the old sort of lazy solution, if I may say so. Oh, you tell us what we have to do. I put it back to them. No, you tell us what solutions you can create that allow you to run the kind of business you want, but still create the outcomes that you know that we need.
So the onus is on them,
They need to solve the problem. And I think some of them are moving away actually quite rapidly from a rather old and a little tired libertarian sort of ideology, which is less and less credible as their businesses get more substantial and as they get more and more venture capital investment, and as they need to be willing to protect more and more people, including institutional investors who are beginning to get more and more interested in this space.
And so just to stick with you for a minute, Martin, you heard Hans saying that, you know, it's not that he doesn't like to say it, but it feels like the post-08 regulation really helped in 2020 in terms of keeping the show on the road. Are you going to take the credit for that? What do you think?
I might take all the credit personally. No.
But you know, has it given you food for thought for new things to work on to increase that resiliency, or do you feel like it's a job well done?
You know, I think the fundamentals of the post-2008 reforms were absolutely correct. So, for example, in relation to margining, you will sometimes hear people saying, "Oh, margining, it's pro-cyclical. We have to adjust it. We have to change it. It's far too pro-cyclical." You have to keep in mind the counterparty credit risk issue that we were fixing, and what happens in financial markets if you have a rampant counterparty credit uncertainty, if I call it. You get mass withdrawals from markets. You get sudden, huge disruption. That's the problem we were aiming to fix. No one ever built margining systems without realizing there was a trade-off, and there were downsides to margining systems. Of course there are. So there is a potential for a little bit of debate around calibration and transparency, but fundamentally margining has been a huge success. If you turn then to the work we've done with the funds industry on liquidity management, I think that's also been pretty good. I mean, I've been working with the funds industry for well over the past 15 years, and I can tell you, if the quality of liquidity management in the fund sector 15 years ago compared to the quality of the liquidity management in the funds industry today, there's no comparison. Now, the problem is, of course, that in the interim, bond markets have ballooned and the plumbing isn't really good enough to deal with the quality of the liquidity challenges. So an awful lot of liquidity in these markets is hugely fragile. So if we had not improved liquidity management as it has been improved, and the industry gets huge credit for responding, I think, to what regulators did and what we did at IOSCO at global level. If we had not got those improvements, we would be in a dire position now. So there has been huge improvements. I think there is probably still a bit to do, but we're closer to the end than the beginning. Although when it comes to regulation, it's an unwise person who predicts the end of innovation.
Yeah, we're done. It's all finished. I mean, Hans, what are your thoughts here? Because I know that a lot of people in your sort of position are worried about pockets of illiquidity, even in government bond markets. And one of the frequent things that is cited as the reason for that is, it's excessive regulation after 08. Is liquidity looking a bit compromised by regulation at this point, from your point of view?
No, I think I'm very much in agreement with your statements, it is a scientific topic, right? In terms of, okay, it was clear, these are the rules, this is how much collateral you need to hold, this is how you need to organize your liquidity management, and so on. That I think has worked quite well. Everybody adapted to it. We all understand the rules. But what I would call the regulators on today is to provide that same level of clarity around sustainable finance, because there the regulation is very open to interpretation, and we are even required to have our own interpretation, and that could be a train wreck in the future. So that could, I think, if we would lead to the same level of clarity regulatory wise as we got after 2008, that would be very helpful.
Yeah, I mean, Henrik, would that be a sentiment that you would share as well? Do you need greater clarity around sustainability?
I think that sustainability overall has made incredible headway, partly on its own steam and driven by investor demand, shareholders, or other stakeholders. But if we're going to create a more unified market, then we are going to need to have more unified views around it. For example, if you look at the rating side, there's several, if not a plethora of different rating methodologies out there. I think when you look at institutions' balance sheets, there are different views. Even if you look at annual reports of banks or companies reporting, people are coming up with different ways of reporting their approach to net zero. So coming up with a unified approach, particularly in the large G3 markets, starting there, I think would be very helpful. I think that is also going to help counter some of the concerns that investors have around greenwashing. Greenwashing is obviously very much on the forefront of investors' mind, and having standards around it would really help that. But the green space and the whole ESG space is also very broad. So we tend to talk about green bonds and loans, but of course there's social and gender as well. And how you come up for policies around all of that is going to be quite substantial initiative. But I'm really excited to see how the markets develop. We've seen a huge amount of issuance, and we've seen a huge shift by our clients. And it's also very much driven by the issuers who are dramatically moving in an ESG direction. So I think we're going to end up finding a very good landing around it. And clearly 2030 and 2050 in terms of hitting net zero have been a big theme the last 18 months. And I think we're going to collectively, and including ICMA, very much be at the forefront of driving some of the changes. But having common principles, and even if you go, for example, to one of the basics like the GRMA contract around repos and the success that has driven, it is going to absolutely help develop the market and achieve the environmental goals by having common principles.
I mean, one of the issues that's thrown up by this is that our understanding of sustainability is changing so quickly, particularly in light of what's happened in Ukraine. You know, all of a sudden, transition finance is much more important. Fossil fuel finance is much more important. Investors have had a complete rethink on whether or not they should be investing in defense stocks. You know, the short version of it being, you know, as long as the kit is going to Ukraine, we're kind of comfortable with it. It's a total rethink here. I mean, you know, from Christoph, how do you think we are adapting to sanctions on Russia, and how is that changing the sustainability debate, do you think?
That's really a challenging question.
Small question for you there.
I mean, look, the exchanges have always been in the forefront of enforcing sanctions, more on a practical level.
Yeah. Is that a practical challenge for you? Apart from
yes, of course.
Else?
It is. It is actually a challenge in our daily routine, because that's what we do every morning, to go through the sanction lists and to look even on a very personalized level for personal exposure of individuals that we identify. But coming back to your more broader question, the sustainability question. Look, I'm a market liberal, but I'm also representative of a regulated market, and therefore I would say I also like level playing fields, and that is what the standardization should be about, to establish a level playing field. And it is therefore among the very few moments in my life where I would even call for more regulation and more standardization by the legislator. And that is a political decision. This is not within our discretion to decide upon. It's a political decision.
Wants more regulation, said it. Bertrand, have you had to rethink how you think about sustainability? I know it's an important priority for you, but it has undeniably changed since February.
Sorry, about the same question about
sustainability and how Russia's affected it.
Well, obviously, Ukraine is adding its contribution, let's say, to action and thinking in Europe, and already changes are at play. In fact, Europe is now progressively, but rapidly, switching its energy relationship or dependency from Russia to, let's be honest, to the United States already. But beyond that, I think that there is a high importance of having a plan, and a long-term plan that remains valid, I would say, whatever the contemporary circumstances. And this is the reason why the bank, the EIB, has taken the view and taken the view publicly and explained that to the shareholders, that whatever the new constraints that the Ukraine crisis is adding to the, let's say, the definition of the contemporary mix of energy for some member states, we will continue to exclude the generation of energy out of fossil from our energy lending policy. So we will continue to exclude, and we will not suddenly say, oh, perhaps I need a bit of gas for the moment, so we will refinance gas production. We recognize that it is possible that some more gas input is necessary for some parts of Europe, but it has to be financed differently, not by the EU bank. Another thing that I think the current crisis makes very, very obvious, and that was one of the clear themes of the last year's COP in Edinburgh, is the importance of adaptation and resilience. And on this, we have started what we call a path, which is a new approach to our clients. Those clients who are either strong emitters, or those clients who are likely to lend to strong emitters. And in the second category, I put the financial intermediaries that are clients of EIB. For these two categories of clients, now we will continue business relationship only if we have an understanding on their part of a plan either to decarbonize or to become more resilient and to better report on this action. And so we will stop financing those who are strong emitters and have decided not to have any plan to change their profile. So I would say that certainly Ukraine is adding challenges, but it should not depart us from the underlying priority, which is environment and climate.
Yeah. Angelika, what kind of work does OeKB have to do to help to adapt to the new situation with Russia and adapt to this new framework around sustainability?
Well, actually, to the first question of the sanctions and Russia and Ukraine, well, unfortunately, as we are doing the export guarantees on behalf of the Republic, we had to cease the extension of new guarantees. But nevertheless, we tried to provide the Austrian companies that are affected by the war with extra liquidity. So as long as they're exporting companies, because that's within our mandate. On the other side, on the sustainable financing side, well, actually, as I said before, in every crisis there might be a little bit of good. I think we are very much aware of the dependency of the Austrian economy on gas imports from Russia, which amounts to about 80% of our gas imports. So I think that's another point which triggers probably an even faster transition to more renewable, more sustainable energy. I think that's one of the points that is triggered right now, because everybody wants to get out of that dependency. And I think that's one of the points that might be triggered. What we do is, when we do have extra incentives for export finance, once the funds that the corporates need go into either investments that are aimed at lowering the carbon footprint, so it's decarbonization. I think the transition finance is very, very, very important, because we do have energy intense industries in Austria, like the steel industry, like the chemical industry, like cement. That's very energy intense. And so I think we need to enable those companies to continue their investments, their research and development towards a more sustainable future. I think that's very important. And what we do is we like it better to incentivize, so it's more financing on better terms rather than not financing at all. So it's keeping the Austrian export business in the system.
Hans, can you envision a situation where government bond investors, for example, pay more attention to human rights records of government issuers of debt? You know, do you think our way of looking at government debt markets might change as a result of what's happened in Russia?
Yes, but that was already a debate that was going on before Russia. It only becomes more now, even. Because if you write a human rights policy, it is not so easy to do that and still have an investable universe.
Yes.
So you're sort of trying to find, to draw a line in something that is obviously very gray, but you need to draw a line and call it binary. This is allowed, this is not. And I think we're, as an industry, struggling with it, where to draw that line. For example, should China be in, yes or no?
Right.
It's a very interesting debate, and we can talk for another hour on that.
Yeah.
Russia is going to be a bit more challenging going forward, not much reported on, but what I think is key is that all the major index providers have kicked Russia and Russian corporates out of their indices, which means that it is very difficult to come back. There's no asset manager in the world that is underweight Russia. Right? So if there is a rally of Russian stocks and Russian bonds, you don't need to own it to protect your performance.
Right.
And it makes it much more difficult, I think, for Russia to come back. Ukraine, I think, will get, I forecast, a sympathy financing from our industry quite significantly. So I'm not that worried about financing for Russia, for Ukraine. Russia, different story. And you asked for defense industry. I have a bit of a alternative view on defense. I think it should be funded by the state. Not a very capitalist thing to say, but the Austrian army, the French army, and the Dutch army, we all need bullets. However, to finance that in an open market poses us all kinds of challenges. But if it is funded through the state, then you have much more control on where you sell that equipment. And you don't have the challenges that we have from an ESG responsible investing perspective, looking now at the defense stocks.
And just very quickly, can you imagine Russia being investable again in your career?
Yes, because I have a long and beautiful career ahead of me.
I'm never going to retire. on that fun note, we're going to have to wrap up there, but it's been a really interesting discussion. I'd just like to thank you all so much for sharing your thoughts, and I'm sure the audience would too. Thank you very much.